2017 was a year of tremendous growth for blockchain, though not in the expected ways. At the beginning of this year, I and others predicted that 2017 would be the year that blockchain moved from proof of concepts into production. We did see some notable successes in this regard. Ripple became a fully operational platform with over 100 members and payment volumes in the billions, and industries began to form blockchain business networks, for example, the Digital Trade Chain Consortium, DTC, in trade finance. But overall, I expected to see more go-lives than we did. On the other hand, I don't think anyone expected the unprecedented growth in the market capitalization of cryptocurrencies or the really technical boom. So, what will the new year bring? Despite the obvious perils in making predictions, I feel confident that, among other things, we will see the following. Blockchain solutions will continue to come into production as the low-hanging fruit are addressed. Cryptocurrencies will continue to grow, fueled by traditional asset management players and techniques. Companies will focus on changing business models as blockchain begins to transform market structures. New ecosystems with smart contract technology will arise as integration platforms between existing industries. The eco will become professionalized and morph into IPO 2.0. Scalability and performance of blockchains will become a critical issue, and there will be interesting new approaches. People will increasingly recognize that local blockchain ecosystems are a critical success factor. Now, let's unpack the details. Low-hanging fruit. Although it was quieter than expected this year, I believe we will continue to see blockchain solutions come into production as enterprises address the low-hanging fruit by digitizing businesses and use cases where blockchain can make the most impact. In fintech, the two most promising use cases remain payments, where there are $50–60 billion of potential savings to be had, and trade finance, which stands to save some $15 billion. As we saw payments do in 2017, I expect we will see trade finance begin to go live on blockchain in 2018. In payments, momentum will pick up and volumes will increase as larger banks, including correspondent banks, get into the act. These players will be tempted by the advantages blockchain brings in terms of real-time processing, lower risk profiles, lower costs and transparency. Blockchain can serve as a stick as well as a carrot, simply by proving that there are better alternatives to the status quo in many industries. We can imagine, as an example, that blockchain has had a hand to play in the European Banking Authority's EU-wide transparency exercises. We were all somewhat surprised, if pleasantly so, by how well cryptocurrencies did in 2017 as a speculative asset. Indeed, growth was spectacular, with the asset class rising from $14 billion in December 2016 to over $450 billion in December 2017 in terms of market capitalization. I think this growth will continue to be fueled by traditional asset management approaches, including Bitcoin futures, crypto hedge funds and the like, all of which will increase the demand for cryptocurrencies and tokens. New business models. As blockchain continues to change market structures, companies will increasingly focus on changing business models. In the world where middlemen are becoming obsolete, companies will have to learn to stop thinking in silos and be more open to becoming partners in ecosystems or on broader platforms. That, in turn, means deciding what kinds of business models they want, whether it's platform plays, product plays, omni-channel strategies, and so on. These discussions will become multidimensional, encompassing both existing services and, increasingly, the new kinds of services that blockchain enables, particularly as blockchain combines with IT and AI to create new kinds of marketplaces where industry silos come down in favor of broad, horizontal structures. One of the most satisfying parts of 2017 for me was being able to see this start to happen close-hand among some of the companies I have the privilege to work with. Dion Digital has partnered with Mercedes-Benz to develop a new operating system that will help break down silos in the mobility space. Skycel is a good example of IT and blockchain opening up the pharmaceutical supply chain to embrace payments, invoicing and insurance. Tend is rethinking investment management by creating a sharing economy 2.0 for high-value assets. One space I think we should keep a particular eye on in 2018 is the fund industry, where firms like Maloney are using blockchain to rethink asset management. I think we will see more of this, and that the fund industry will start to be significantly disrupted next year. This will start with the management of crypto assets, but over time we will see traditional assets increasingly being tokenized, migrated onto blockchains and managed on-chain. The morphing of ecos. With startups raising over $3.5 billion in ecos, 2017 was clearly the year of the token launch. To me, though, the eco boom is significant, not necessarily because of the amounts raised, but because we are seeing the beginnings of the democratization of venture capital. And though the concept had a great 2017, change will come to the world of ecos in 2018 as more traditional players get involved. Over the next 12-18 months, I expect people with experience and expertise in the IPO world will embrace tokenization as a technical platform, and the whole business will be professionalized, with book building, pricing, startup evaluation, and so on happening more along traditional lines. As we've already begun to see, it will be harder to get funding simply on the back of a white paper. Investors will demand sound business plans and high levels of transparency, with all that entails. Scalability in ecosystems. One of the key challenges of existing blockchain technology is scale and performance. I predict that next year we will see alternatives to current blockchain technologies that will be more scalable, faster and minimize energy consumption. IOTA, which has gained a lot of traction lately, is, I think, a project to watch in this regard. I also believe people will increasingly find that local blockchain ecosystems, where critical services are co-located in one geographical area, are critical success factors for blockchain projects. This is certainly what we see in the Crypto Valley in Switzerland. As the president of the Crypto Valley Association, I hope readers will forgive me for predicting, or at the least, pitching for, the continued success of Switzerland as a blockchain ecosystem. Crypto Valley has a high concentration of all the services blockchain projects will need to raise money and set up shop, including legal, advisory, tax, accounting, smart contract platforms, All My Love utilities, and marketing expertise. This, coupled with Switzerland's other advantages, from its state-of-the-art infrastructure to its highly skilled workforce, will, in my opinion, mean it should remain a great draw for blockchain companies, in the new year and hopefully for many years to come. Writing the blockchain rulebook in 2018. The regulators are coming. They have formed committees, subpoenaed documents, studied white papers, and will march into 2018 armed with enforcement actions. These actions will be more in the vein of reactions, as regulators will attempt to stem the darker tides of cryptocurrency, promises of ludicrous returns, Ponzi schemes, and other obvious violations of securities laws. When the gavel lands, even the best-meaning and most honest developers may have to cope with a rulebook built for criminals. That's one scenario. Here's another. Industry leaders take action tailored for a specific business purpose, time and market sentiment. The rest of the industry follows without fully considering the fit for their businesses. This occurred spectacularly as the eco or token sale frenzy took off over the summer. Businesses traditionally averse to crypto created and sold blockchain tokens without asking why their business needed access to a distributed network of computers. Regulation through penalties and accidental leadership have both set the industry's standards to date. This coming year presents an opportunity for a third way forward, where key contributors develop principled standards and encourage their use through a self-regulatory organization (SRO), a certification entity, via new law drafted with regulators and lawmakers, or through new frameworks that creatively navigate old law. Regulation through penalties. Regulators turn to regulation by enforcement, because the law moves achingly slow. The Administrative Procedure Act requires a notice and comment period between the proposal of a rule and its final publication in the Federal Register, where it carries the force of law. A notice and comment period tends to stretch rulemaking out at least a year. This timeline means every government agency that could potentially issue comprehensive regulation over token sales and the secondary markets, including the Securities Exchange Commission (SEC), the Commodity Futures Trading Commission (CFTC), and the Financial Crimes Enforcement Network (FinCEN), must, by law, move at the speed of glue. The only way for a guard dog to stay relevant is to bark or to bite. Put more elegantly, a regulator can make its presence known by either pronouncing a new interpretation of old law or putting someone in prison and assessing a hefty penalty. FINS embarked in 2013 guidance and drew the acceptance and transmission of convertible virtual currencies close enough to take bites at the industry. The SEC barked in its Dow report and warned cryptocurrency exchanges not to list security tokens without the proper registration, and recently warned issuers to avoid promises of exchange listing. The CFTC bit, in a few different places, and now takes the position that margin trading of cryptocurrencies and fraud in the Bitcoin spot markets can both fall under its jurisdiction. Regulation by enforcement is not the same as true rulemaking. It is standard setting by fiat. True rulemaking usually involves careful study of a range of issues, serious inquiry into the most pressing and harmful ones, and a principled approach that responsibly resolves the issues or minimizes their occurrence without chilling innovation. Regulators can take a careful, studied approach prior to issuing new proposed rules. Proposals of one regulator often contain upwards of 800 pages of research, summaries of comments and exacting policy positions for each subsection of a new rule. But that process can't happen through the federal government anytime soon. The necessarily slow pace of rulemaking is inadequate to govern rapid advancements in applied cryptography. The industry should view 2018 as a golden moment to set its own standards. The time may pass for the industry to pen a comprehensive set of guidelines with fresh ink. Let that moment slip and regulators will draft rules within the chart outlines of criminal enterprises. Accidental leadership. To be clear, standard setting through leadership has occurred already. But it has been either reactive or accidental. The reactive standard arrives piecemeal, in response to crisis after crisis. The White Hat response to the parody hack was a prime example of specialists spearheading efforts in a reactive fashion to stop the theft of funds where the government could not. Cryptocurrency exchanges have reacted swiftly and intelligently to customer complaints and flash crashes in the market, offering examples of how to set new standards on the fly. Other standards arise simply because companies desperately want to replicate success. This has resulted in standard following without introspection. Token sales, mentioned above, have become a fundraising option set to outpace traditional financing in fintech. But many companies selling tokens do not have a good reason for developing on a blockchain. Other companies opt for a Swiss foundation without fully thinking through the operational implications of running a business out of several countries. These practices became the market standard by accident. A principled approach. A mature industry will need a principled set of rules in order to thrive. The best way to develop those rules is to reach out to smart, engaged community members and to seek their input. The Uniform Law Commission did exactly this as it worked with CoinCenter to develop a new uniform virtual currency licensing law that could be adopted by all 50 states. We believe Cooley did this as well with the SAFE project, an open-source effort inviting community input to develop a token sale framework that navigates existing law. The Brooklyn Project is another example inviting public comment. New technology on the horizon will need new standards. Otherwise, newbies will be harmed. For instance, decentralized exchanges have no standards for protecting against spoofing, wash trading or other market manipulation. Open-source software will one day allow anyone to create and trade regulated financial instruments from their smartphone with a few simple taps. New entrants will thus risk exposure to derivatives touted by anonymous sellers as lucrative investments on unregulated markets. The industry can wait for regulators. But even when regulators take the time to think about their rules, they can come up short. Take New York's BITES license and compare it against the Uniform Regulation of Virtual Currency Businesses Act. One took industry input that regulators decided in their discretion was either valid or not, while the other had regulators and industry experts working in concert to draft law. Place these two work products side by side and see how stark the differences are. Many companies that did found the poorly tailored BITES licenses requirements too onerous and decided not to operate in New York. This drove innovation and opportunity out of a key state and into other markets. The industry has a few paths toward principled standard setting: form an independent, profit-agnostic SRO that proposes standards to govern token sales, secondary market activity, or the creation of new financial instruments. FINRA and FA offer excellent examples of how ROs serve, respectively, the securities and commodities industries. Create a certification entity that certifies compliance with any new standards, whether set by an SRO or otherwise. Work with regulators and lawmakers to identify salient risks and codify rules that deter bad actors from engaging in activity harmful to investors or consumers. Propose regulatory frameworks, much like the SAFE proposal, so the industry can comply in innovative ways without halting deal flow. The market follows leaders, which means the market can follow itself off a cliff if it isn't careful. The time is ripe to set principled standards, or the industry risks having regulators and accidents of history set in helpful standards for all.